By now, you would have probably heard of the news that the 3 US banks are going bankrupt in just one single week. In this video, we will discuss what happened to them and the repercussions involved. So you also need to stay tuned to the end of the video because we will dive into two important things you need to check when you want to analyze any banks. This will also help you to understand why our local banks are in a much better shape than the US ones. But before that, do help us to like and subscribe to our channel and ring the bell for more interesting stock ideas and learn how to invest better. In return, I will also share with you a financial meme. Okay, with that, let's dive in. Right? So first of all, I'm going to explain the bankruptcy in layman terms. So what happens is that actually Silvergate and the Signature Bank are the two main banks for the crypto industry. So bankrupt crypto exchange FTX was also a major Silvergate customer, and both the banks have reported huge losses recently and withdrawals in the crypto crash. So for Silicon Valley Bank itself, as the name suggests, it is a lender to the tech startups like Roku, ST, Roblox, and even Pinterest. So for example, over here we can see that Roku had about 487 million out of its 1.9 billion cash sitting at Silicon Valley Bank. And that's a scary 26% as of the 10th of March. Roblox, on the other hand, has about 5% of its 3 billion cash sitting at Silicon Valley Bank as of 28 February. So with that, right, what are the implications or risks involved that we should know of? So firstly, according to the FDIC, the government, right, US banks are sitting on a 620 billion in unrealized losses. Unrealized meaning assets that have decreased in price but haven't been sold yet. Right? Okay, so this figure stands at the end of 2022. So in order to understand this, right, we need to dive into the story. So back when interest rates were near zero, US banks were scooping up a lot of US treasuries and the bonds. And now, as the Federal Reserve hikes the rates to fight inflation, those bonds that they have bought have declined in value. And simply put, banks may find that they have less cash on hand to cater to all the withdrawals because of the security prices dropping far more than what they expected. And that being said, right, falling bond prices are only a real problem in a situation where the balance sheet is sinking quite quickly and you have to sell assets that you don't ordinarily have to sell. I also managed to dig around and found this piece of content well written by the Chief Investment Officer of UBS, which says, I quote, Silicon Valley Bank financials heavy reliance on deposits from the venture capital backed businesses is very unique and created this vulnerability. Most large and regional banks have much more diversified deposit bases. And at this point, UBS think that this is a low risk but are monitoring the situation very closely. So in other words, from my perspective, if you were to look at US banks, right, it is more advisable to go for the Jacola ones with a few billion or at least 1 trillion in total assets, such as JP Morgan, Bank of America, and Citigroup. So what about curve banks, DBS, UOB, OCBC? How do you actually spot this kind of thing when the non-performing loans, right, they don't really flag up anything until it's too late already? Well, okay, I wouldn't aim to be an expert here, okay, but there are two things that I will look at after this US bank fiasco, right? So first of all is the source of funding. So where are the deposits coming from? Second, the bank's loan portfolio or who they are lending money to, so that you can actually gauge their industry or sector risk. Okay, so now let's hop over to the video, right, where I will share screen on the three local banks corporate presentation. Let's look at OCBC first. Okay, OCBC, their deposits are mainly formed by the customer deposits of CASA, stands for current account and savings account. So these are very highly liquid in nature. And on top of that, we have fixed deposits. And you can see over here, other than the others, right, fixed deposits and CASA contribute a bulk of their total 350 billion worth of deposits as of December 2022. So I would say this is a very safe customer deposit space. Okay, and moving on to their loan portfolio. Okay, over here you can see their loans by the geography, whereby they have Greater China, rest of the world, all right, and Singapore. So Singapore, of course, is the bulk of it at 120 versus around 300 billion worth of loans. But there's only around a third of them. So Greater China contributes 73 out of the 300. So this is something that maybe we need to take note of. Other than that, right, you can also look at the Greater China loans in more details over here, which are segregated also into Hong Kong, offshore, mainland China, and all that. The other one is the loans by industry. So loans by industry, we have housing loans. So I presume that, housing loans are mainly in Singapore and China and Hong Kong. Building and construction, investment or financial related, and all that. Okay, so this is for OCBC. Next, we will move on to UOB. UOB wise, okay, it is not so straightforward. So if we were to look at it, right, you can go to this total funding slide, okay, and you can check out the different geography similar to that of OCBC. Okay, but over here we can see that Singapore actually contributes a bigger proportion versus that of OCBC. So December 2022, we have 249 billion coming from Singapore out of the 369 billion total customer deposits. Okay, and we have also wholesale funding, which they mentioned comprising of the debt issuance, capital securities. This is where, sometimes for the US banks, this is something that we need to take note of. However, if you were to see this commentary over here, CASA, which is current account, savings account ratio at 47.5%. So this is what I would say still a very highly liquid source of funding. Okay, next up is their loan portfolio, which you can find over here. All right, and so you can look at their entire loan portfolio by industry over here, right? So I think pretty similar to that of OCBC, but UOB is slanted more towards the building and construction at 27%. Then next is the housing loans, and followed by financial sector, general commerce, professionals, and all that. Next, okay, lastly, we will talk about DBS. And for DBS, okay, you can see that their customer deposits are the most out of the three local banks. As of 31st December 2022, their total customer deposits stand at $527 billion. And although we don't have the slides to drill down into a lot more things, over here is already broken down into fixed deposits, okay, 203 billion, savings and current accounts, I would say total at around $316 billion. So only a very small proportion come from others, which I wouldn't say is a real concern over here, because a bulk of it okay, I think more than 95% are highly liquid because it's CASA plus fixed deposits. And if you were to look at their loan portfolio, and for the customer loans, right, you can see they are broken down into by business unit, okay, institutional banking, part of it, and by geography. So Singapore, Hong Kong, as well as China, yeah, also contribute a majority of the 420 billion in loans. Okay, and by industry wise, we also can see that is predominantly, the first one is of course building and construction, followed by housing loans. So uh, if we were to look at it, right, anything that impacts the property development or the housing sectors, right, will affect the three local banks significantly. But all in all, right, if you can see all the different customer deposits for all the three local banks, they are in a much better shape as compared to the US ones, which sometimes get the money from cryptocurrencies or get the money from Silicon Valley tech startups, which, in any case of emergency, they will want to pull out all their funds all together. Okay, so to end off, I would also like to do a quick comparison of the various banks using Seeking Alpha. In this table, we have the few big US banks, all right, as well as the DBS Bank, plus the Silicon Valley Bank. Okay, and first of all, for me personally, I like dividend paying banks. So I will check out the dividends section, which is over here, all right, the dividend section. And we can see that the dividend yield forward and trading 12 months for Bank of America is around 2.9%. Same for Wells Fargo. DBS is a lot more higher, right? 4.3. I believe this one is the increase in the dividends per share or even including the special dividends. So it has gone up to 5.2%. JP Morgan is around 3%. Silicon Valley, of course, no need to say, there's no dividend yield per se. And Citibank gives quite a high yield as well, 4.22%. Another thing that I want to look at is perhaps the dividend growth 5-year CAGR. So I want to see that, their dividends per share has been increasing over the past 5 years. This is the same, this is true for Bank of America. Okay, Wells Fargo, no, because it's negative. DBS, yes, 18% growth year-on-year basis. That's pretty impressive. JP Morgan, 13.5, and Citibank, 12.7%. So I would say more than the 10% growth in the dividends is quite a nice number to have. Okay. And the next thing that I will look at is perhaps their ROE, to look at their profitability efficiency. Okay. So profitability, I will come over down to this section, and ROE. So a good way of seeing how well the bank is performing is by this simple ROE matrix. Okay, over here you can see that most of them are doing quite well, but of course DBS has the highest ROE at 14%, followed by JP Morgan, then Bank of America, Silicon Valley, surprisingly, because maybe they have a lot of deposits, but that is a risk of concern, okay, during this point in time. Wells Fargo and Citibank. Okay, so the last thing that I want to look at is of course the valuations. So valuations for banks, usually people look at the price to book because we are always concerned about the book value per share. And over here, okay, DBS unfortunately is among the highest, 1.5 times similar to that of JPM. So both the banks are one of the best well-run banks. JPM has the highest total deposits. DBS is Singapore's de facto bank. So it's perhaps reasonable that they have a higher price to book. All right. The next one would be Bank of America, Wells Fargo. Then we have Silicon Valley Bank as well as Citibank, and only 0.5 times price to book. And I have saved this whole comparison as a PDF file. If you want a copy of it, just subscribe to my channel and leave a comment down below saying, I want the PDF. Okay, so I will leave the file in a pinned comment once we have at least 5 comments. Okay, next up, if you want to check out 5 defensive Singapore stocks with at least 4% dividend yields, do check out this video over here. And I will see you next time. Thanks for watching and bye bye.